So till the time is figuring out, I'd like to give a brief introduction for the speaker of the day, CA Ankit Goyal. Welcome, sir, to this webinar for today. So first of all, the topic for today is International Valuation Standard 200, ICAI-RBO Valuation Standard 301, Business Valuation. So Mr. Ankit Goyal, he's a registered valuer under the category SFA, a practicing chartered accountant, a founder partner under AAA Valuation Professionals LLP, which is an RPE recognized by IPBI for all the three asset classes. He's a founder partner of AAA Insolvency Professionals LLP, a regular speaker for insolvency, valuation, and forensic audit. He has been invited as a speaker across various webinars hosted by All India Institute of Valuers Foundation. And today he'll be enlightening us on today's topic, business valuation. On to you, sir.
Thank you, Mehak. Thank you so much. Good afternoon, everyone. Good evening. So 31st March, and we are all under pressure to complete our CPRs. And it's good to have all of you here. Thank you, Mehak. Thank you, AIIOBF, for giving this opportunity to share my thoughts on this very important subject. So this is the subject that I would say is dearest to chartered accountants, to securities or financial assets valuers, because this is the DCF method or going concern valuation method or going concern valuation that we understand the best. And I think I will try and do justice to the topic given to me. I have prepared a presentation, and I will just share that on the screen. Just give me a second. While I am able to do that, I will perhaps like to communicate that I will like that this session is an interactive session. I will try and give examples on things that we do on a day-to-day basis whenever we do these kind of valuations. I will request other professionals who are experienced in valuations to share their ideas and their knowledge about how do they do the same things and how do they take into factor the various things that we will be discussing today. And I will also like to have questions on whatever slide that I am on without maybe even without me asking for for somebody to share a question. I will request everyone to share their thoughts, share their questions as we go by. So that's my request. Questions help us in the sense that it makes the whole session interactive and also allows everyone to learn from any question that is asked by anyone. So so what is different about so my first question is, what is different about valuing a business as compared to valuing any other asset? So maybe any of you can participate and try to share that what is different. How is valuing a business interest different from any other asset? What is essentially the difference between the two? I think you can all
I'd like to know if you're here, sir.
I think I was just disconnected for a second, so I should be okay now. So I will just share my screen. Anyone who would like to share their thoughts on this idea that the question that I just asked? So okay, I will proceed then. Sorry, I think I am sharing the wrong presentation. Just a second, please. Just a second. So I have two presentations for today. So I think I just messed up the title. So yeah, I hope all of you can see the screen. So the idea is that a business interest is different from any other asset, primarily because a business consists of many uh, other assets which are components of the overall business. So business which is in manufacturing might be using plant and machinery, which is being employed by the business to maybe manufacture certain goods, maybe render any services. A business interest or a business might be using any intangible assets, including maybe a brand, maybe a website, maybe they might already have some customers with them. And there can be many other examples where the business might be owning certain assets, owning certain items which are used for one main objective, and that one main objective is to make profit or expand the business or increase the business size as you go along. When you talk about a business, you normally understand that a business is any activity which somebody does for the purpose of earning profit, for the purpose of creating value addition for the business owners or the stakeholders. So that is what a business normally is. Uh, Business interest is also something that can be envisaged. So there can be a situation where you have a piece of assets which have not been used for doing any business for the past 2 or 3 years, and you still might find a reason to assume that in the long run, the buyer of those assets will be using those assets for the purpose of uh, running a business. And therefore, if all of those assets are valued collectively, then you might have uh, on your table the job of valuing the business as a whole, assuming that there might be a cost of getting customers on board, doing some marketing, and so on. So it is therefore important for all of us to understand what makes a business interest different from other assets. Any other opinion, any other comments on this idea or what I just shared about a business interest, how it is different from individual assets or maybe even some assets put together? So anyone can share in case they want to. I will proceed forward. So I normally start with understanding the Mr. Venkateshwar. I think the voice is okay for everyone else. Let me know in case it is not. Maybe you can try and increase your volume or wear headphones. I am already speaking loud enough, so maybe the problem is at your end, unless and until other people also have an issue. So the legal framework is very simple. We are currently working under as a registered valuer. I think I don't need to look into this too much. This is something that we can skip for now. Um, so the idea is that we are about 3,945 registered valuers in total, and 40 registered valuer entities have been registered so far by the IBBI. And of course, we are in the process, in the transition phase of having the draft value bill converted into an act, and and then of course we might have the National Institute of Valuers coming up. So all the registered valuers who are with me should know that the future seems to be bright as well as challenging, in the form that we will have a dedicated regulator on valuers who will be taking care of all the regulations and setting standards for the valuers in India. That is what we are expecting. And of course, we will have more avenues, more regulatory, more acts or more laws under which we will be doing valuations in future. Seems so. International valuation standards are here to stay till the time the central government notifies the valuation standards which are particularly made for India. Even in that case, the main idea and my thought process is, my personal thought process is that it is very likely that those valuation standards will be similar to IVS or other international accepted standards. The idea behind the same is that we will like, or the government will perhaps like, to have standards which are at par or rather above the international practices, to create an export market or create good reputation for valuation professionals doing valuations for the globe. The As of now, based on the idea that there are no standards which are prescribed, it is very clear from Rule 8 that the standards that are required to be followed are standards which are internationally accepted standards or valuation standards adopted by any registered values organization. To my knowledge, AIIOVF has adopted international valuation standards. The effects of non-compliance with valuation standards are harsh. They can include penalties, fines. They might include complaint against registered valuer by the aggrieved party. The report that is given by the registered valuer might be challenged. There might be an issue for your client with respect to a report that you have issued which is not in compliance with the valuation standards. So we need to look out. We need to make sure that our report uh, uh, is meeting the required standard. With respect to IVS, IVS is structured in this manner. There is an introduction that starts, and then there's a glossary which talks about important definitions and important words used in the entire standards. There is an IVS framework which mainly talks about the idea that the IVS framework is meant to be followed in such a manner that standards 101 to 105 are general standards, and the standards thereafter are specific standards. And it says that 101 and 105 will be applicable to all valuation reports and review of valuation reports, whereas the ones that are thereafter are mainly concerned with specific asset classes, and they will be applicable whenever you are doing a valuation for that asset class over and above the standards 101 to 105. So those standards will not override these standards. These standards will continue to operate. But these standards, that is business and business interest, that is IVS 200, which we're talking about today, intangible assets, non-financial liabilities, plant and equipment, real property interest, relevant property, financial instruments, these are all something that are specific asset standards which need to be complied with. Coming to the generic standard, that is 105. Now, why are we talking about 105 when our subject is IVS 200? The reason why we are talking about IVS 105 is because IVS 105 talks about generic approach on income approach, and we need to understand this approach to make sure that when we read the IVS 200, we are not missing out any requirement that is also referred to in 105. Because whenever you're doing a business interest valuation or a business valuation, one is supposed to look at IVS 200 as well, read with IVS 105. At many places, this will be specifically stated in IVS 200. In some cases, it will not be, and the IVS framework itself says that IVS 105 is required to be followed, irrespective of the fact that you're doing a valuation for a business interest under IVS 200. So make sure that you are compliant with that and you are reading both. So the reason why we are looking at income approaches that IBS 105 right now is to understand the the important parts of IBS 105 which are stated herein. Uh, Income approach IBS 105 says provides an indication of value by converting future cash flows to a single current value. Under the income approach, the value of an asset is determined by reference to the value of income, cash flow, or cost savings generated by the asset. The income approach should be applied and afforded significant weight where there is an income producing ability of the asset is the critical element affecting value from the participant perspective. So I believe all of you agree that whenever we are valuing a business or a business interest, the business or business interest, the main characteristic normally is income producing factor. In some exceptions, maybe there is no income, maybe there's still loss, maybe there is still no PAT, maybe even in some startup cases, it will may not be even a revenue or maybe a turnover also. So in those cases, there will be alternative methods that you might like to try because you might not be able to project income that might be earned by that business in future. But the idea is that you need to understand that income producing ability of the asset, wherever that is the main consideration, then you will value the asset using income approach. In case of tangible assets like plant and machinery, land and building, where the main idea behind purchasing an asset and putting that into use is maybe earning rental income on the same, income approach might be the good idea or the best idea to follow there. But wherever the income wherever so that might also be possible, but we are anyways talking about business and business interests where income producing ability is normally the norm. Reasonable projections of the amount and timing of future incomes are available for the subject asset, but there are few, if any, relevant market comparables. So in that case, income method will normally beat the market method in giving you more comfort in getting a value. So it's not important that you can't get a value for a business using market approach. You may get a market approach, use market approach and get a value. But sometimes the market comparables are not available. There you might like to use income approach. Sorry. So the idea is that now we will talk about discounting cash flow method. That is the chief and the main method that is followed to value any cash flow generating business. The idea is very simple that you are forecasting the cash flows, and those forecasted cash flows are discounted back to the valuation date, resulting in a present value of the asset. So you kind of imagine that you are trying to identify the benefits that will accrue to you in future. So it's an anticipation of benefits concept. That is what income approach is. And you're trying to calculate the present value of something that will come to you at a later date, or that also might go from you, or cash outflows that might happen at a future date. So it might be a scenario that you might have cash outflows, maybe worth 100 crore rupees in the next 2 years, and you might have cash outflows worth So sorry for the disconnection again. I think there is some problem with my internet connection. I will quickly share my screen. So I will continue. Uh, hope I'm audible to everyone. Am I audible to everyone?
Yes, sir, you're audible.
Yeah, perfect. So that's what we will be looking at, the DCF method. Let's proceed. So key steps in the DCF, maybe we all know that, but let's make a quick revision. So first you choose the appropriate type of cash flow for the nature of subject asset. You might want to choose pre-tax, post-tax, total cash flows or cash flows to equity, real or nominal cash flows. You need to choose which types of cash flows will you like to pick up. Then determine the most appropriate explicit method. So you might want to go for a 5-year cash flow projections, 10-year cash flow projections, depending on which model you're looking at. Prepare the cash flow forecast for that period. So these forecasts might be provided by the management to you. You might want to prepare them yourself. The idea is that if they're provided by the management, then you're supposed to vet them. You're supposed to check if all the assumptions and assumptions based on which those projections have been made are sensible and they are practical. Determine whether terminal value is appropriate for the subject asset at the end of the explicit period. So you determine whether terminal value is appropriate, then determine the appropriate discount rate, apply the discount rate to the future cash flows, and that is what you will end up. These are the key steps to a DCF. Let me know in case anyone has any questions on these key steps, or anyone has any questions on this at all. When you look at the type of cash flows, you normally look at appropriate type of cash flows, so the nature of the asset. So cash flows to whole asset or partial interest. So typically cash flows to the whole asset is used. So there might be a system that you want to value maybe the equity shares which are owned by the minority shareholders of a company. So in that case, normally the steps that you do is you perform are that you value the entire company as a business going concern, and then try to value the percentage share that you are valuing. The cash flows can be pre-tax or post-tax. The tax rate applied should be consistent with the basis of value, and in many cases would be a participant tax rate rather than the owner-specific one. So the idea is that the tax rate needs to be factored in primarily to understand primarily to give effect of the cost of capital to the person who is supposed to get those cash flows. Nominal versus real. So your real cash flows does not consider inflation, where nominal cash flows does include expectation regarding inflation. So it is expected that cash flow incorporates an expected inflation rate. The discount rate has to include an adjustment for inflation as well. Currency, the choice of currency used may have an impact on assumption related inflation and risk. So whatever currency you're choosing is basically your home currency, your main country, or your home country based on which you will be taking decisions. So make sure that the currency that you're choosing, if you're choosing INR, then the discount rates and all the inflation numbers will be based on the same number. The type of cash flows contained in the forecast. So cash flow forecast may represent expected cash flows, probability weight scenarios, most likely cash flows, or contractual cash flows. So make sure that you are talking about what kind of cash flows are you talking about. The type of cash flows chosen should be in accordance with participants' viewpoint. So an example that the IVS itself gives is the cash flows and discount rates for real property are customarily developed on a pre-tax basis. So there are some things that are customary. So just make sure that all of the assumptions that you're taking with respect to type of cash flows, the discount rates are matching each other. You don't want to take a discount rate which is computed without taking into effect the tax rate, and at the same time start using post-tax cash flows for the entire business. When a valuation is being developed as in a currency that differs from the currency used in cash flow projections, a valuer should use one of the following two currency translation methods. So make sure that wherever you are in having a business which is maybe in multiple countries, make sure that you're adjusting for these things wherever the currency plays a role. Explicit forecast period, the selection criteria will depend on the purpose of valuation, the nature of the asset, the information available, and the required basis of value. So for an asset with a short life, it is more likely to be both possible and relevant to project cash flows over its entire life. So if somebody says that my business is going to last only for 5 years, and I don't think I will be able to continue this business beyond 5 years. So the idea is that using a DCF approach, you better take those 5-year cash flows and then project everything, and then see that whatever value will you be able to fetch at the end of those 5 years. But at the same time, if somebody says, no, I am a very big entity, I am maybe a listed entity having thousands of crores of turnover in India, and I have plans to grow, but I see myself living till eternity. I don't see the organization dying any soon. So in that case, you say that, okay, let me take 5-year projections, 10-year projections, and then beyond that, you assume a standard growth and then kind of project the terminal value based on that method. In some circumstances, particularly when the asset is operating at a stabilized level of growth and profits at the valuation date, it may not be necessary. So basically, explicit forecast, that how many years of forecast you want to take based on all these factors. So the intended holding period of the investor, the stability level, the kind of growth that the company is having, what kind of projections does the company have. The company comes back to and so that comes back to you and say, I will grow at 25% every year. So you have to ask that, 25% growth is an abnormal growth rate. Maybe you will grow at 25% for the next 5 years, but after that, maybe you will grow for maybe 10, 15% for the next 5 years. So you have to ask that, what kind of projections are you making for the next 5 years? So that is how you can calculate the explicit forecast period. I will just try and connect my mobile. I think there is an issue with my internet today. Let me just continue straight away. I think we'll just save time this way. So the explicit forecast period may be relying on the life of the asset, the reasonable period for which reliable data is available. So if you don't have data beyond 5 years, the management says, I can't project what kind of growth I will have. And you can then make an assumption and say that, okay, I will project for 5 years and then beyond that, I will not do that. The minimum explicit forecast period should be sufficient for any asset to achieve a stabilized level of growth and profit so that you can then compute the terminal value. And the valuation of cyclical assets, you have to talk about cyclical period also. You have to take into factor that part. For finite lived assets, such as most financial instruments, the cash flows will typically be forecast over the full life of the asset. Any questions on this? Please let me know. Cash flow projections, the cash flow of the explicit period is considered using prospective financial information, that is projected income inflows and expected outflows. So as per para 50.12, regardless of the source of PFI, a valuer must perform analysis to evaluate that the assumptions underlying the projected financial information and their appropriateness for the valuation purpose is good. So it is your duty, the valuer's duty, to look at those projections and then make sure that these projections are worthy of putting into action. Cash flow forecast. So the cash flow is divided into suitable periodic intervals. It can be weekly, monthly, quarterly, annually. It's normally, whenever you do a forecast, you normally do it annually. You might choose a different interval based on your understanding or your requirements. So in case of seasonality, it is normal to have quarterly or monthly, also monthly intervals in case of a quarterly, in case of a seasonal business. So make sure that whatever length you're taking and whatever frequency you're taking is followed throughout. The projected cash flow should capture the amount of and timing of the all future inflows and outflows associated with the subject asset. So typically the projected cash flows will reflect one of the following. It might include projected contractual or promised cash flows, the single most likely set of cash flow, the probability weighted expected cash flow, multiple scenarios of possible future cash flows, and so on. Different types of cash flows often reflect different levels of risk and may require different discount rates. So probability weighted expected cash flows incorporate expectations regarding all possible outcomes and are not dependent on any particular conditions or events. So I think all this is something that you need to take care of. While the valuers often receive prospective financial information that reflects accounting income and expenses, it is generally preferred to use cash flows that would be anticipated by participants as the basis of valuations. So you must look at the cash flows that are expected rather than what has been historically the trend. So historic trend is important, but there has to be a bend towards what kind of changes are expected in the future or what are kind of changes in the business are going to happen in the future. That must be taken into factor. Terminal value should consider whether the asset is deteriorating, finite lived in nature, or indefinite lived asset, whether there is future growth potential for the asset beyond the explicit forecast period, whether there is a predetermined fixed capital amount expected to be received at the end of the explicit forecast period, the expected risk level of the asset at the time of the interval is calculated. So the terminal value should also consider for cyclical assets, the terminal value should consider the cyclical nature, that is peak or through levels of cash flows in perpetuity, the cash attributes, the tax attributes inherent in the asset at the end of the explicit period should also be taken into account. Valuers apply any reasonable period for method for calculating terminal value. The most commonly used are Gordon growth model, instant growth model, which is the most typically used for indefinite lived assets. They may use market approach or exit value for wherever there is a deteriorating of finite lived asset and indefinite lived assets. And they might also consider salvage value disposal cost, appropriate only for deteriorating finite lived assets. The Gordon growth model is very clear that you kind of at the end of the terminal value period or at the end of your projection period, you say that, okay, what will the income be for my next year? And then you use this formula, which is a very, very old formula for calculating the present value of a cash flow that is going to continue till perpetuity. So the idea is that if D1 is the income for next year, then in the present value in the first year, the value is rate minus the growth, that is the cost of capital minus the growth that will happen in future. This is a formula derived from and also called Gordon growth model. So this is the most actively used formula for estimating the terminal value at the end of the forecast period. Market approach exit value, the market approach exit value method can be performed in a number of ways, but the idea is that you kind of start expecting that if I'm projecting my cash flows for the next 5 years, after the 5 years that end, then what will be the exit that I will get? So if after 5 years you expect that I will get an exit for 100 crores, then that is your discount rate. That is your terminal value. Salvage value disposal cost, you can say that no, at the end of these 10 years, I will have to salvage this, I will have to sell this off. In that case, it becomes a salvage value. The rate at which forecast cash flow is discounted should reflect not only the time value of money, but also the risk associated with the type of cash flow and the future operations of the asset. The discount rate must be consistent with the type of cash flow. Valuers may use any reasonable method for developing an appropriate discount rate. The possible methods are a CAPM model, that is capital asset pricing model, a weighted average cost of capital, observed or inferred rates, yields, or a built-up method. These are possible methods to get a discount rate. The valuer should also consider corroborative analysis when assessing the appropriateness of discount rate. So for that, one may use internal rate of return, that is IRR, weighted average return on assets, that is VARA, and also use value indications from other approaches such as market approach and compare those values that are computed using market approach with the income approach, income approach method that is followed. CAPM is the capital asset pricing method model. Whenever you use a WACC, so I think I have a question from Mr. Tarun Thavani. So Tarunji, the idea is that CAPM model is often used to value the cost of equity. And once you have the cost of equity, you normally use weighted average cost of capital formula or structure to use the cost of capital computed using CAPM and use the discount, the cost of debt, and combine the same to compute a WACC. And the WACC can include different combinations of various financing styles. It can be debt, it can be preference shares, it can be equity shares. So it can be multiple options that can give you a weighted average cost of capital. The CAPM is normally used to understand the cost of capital for equity, that is cost of equity, that is the cost of equity, and that is normally an input for WACC. Hope I could make that clear for you. In certain cases, when there will be no debt, then VACC or WACC will not be used. It will only be a CAPM method that might be used to compute the cost of capital. So in developing a discount rate, the valuer should consider the type of asset being valued. So the discount rate used in valuing debt would be different to those used when valuing real property or business. So you should understand that this standard is generic in nature. This is for every asset. This is not only for a business interest. This is part of IVS 105. Therefore, it talks about other possibilities also. Whenever you're doing a discount rate for a business per se, you normally understand that what will be the value, what will be the cost of capital for financing that business. So that cost of capital in most circumstances will be a WACC, which might include different ways that one will fund that business. The owner of that business or the market participant of that business might want to include maybe 60% equity, 40%, 60% equity, 40% debt, maybe something else. So that is what you kind of estimate and then give a value of. The rates, implicit and comparable transaction in the market are important to be understood. Geographical location of the asset and the location of the market in which it would trade, the life term or maturity of the asset and consistency of inputs, the basis of value being applied, the currency denomination of the projected cash flows, all these are important to understand the discount rate, to compute the discount rate. So in developing a discount rate, the valuer must document the method used for developing the discount rate and support its use, provide the evidence of derivation of the discount rate, including the identification of significant inputs and support for their derivation or the source. Valuers must consider the purpose for which the forecast was prepared and whether the forecast assumptions are consistent with the basis of value being applied. The valuers must consider the risk of achieving the forecasted cash flows to the asset when developing the discount rate. So all that needs to be done. I will try to rush up because we have limited time. There are many ways to assess the risk of achieving the forecast cash flows. A non-exhaustive list can be identifying the key components of the forecast cash flows and look at historical operating and financial performance of the asset, historical performance of the comparable asset, expected performance, historical and expected performance of the industry. So all that can be looked at. Confirm whether the forecast cash flows represent expected cash flows, that is probability weight scenarios, as opposed to most likely cash flows of the asset or some other cash flows. So all these considerations are important. While there are many ways to assess the risk of achieving the forecast, so the non-exhaustive list can also include utilizing expected cash flows, consider the relative dispersion of the potential outcomes, compare prior forecast of assets, consider qualitative factors, consider the value indications such as those resulting from the market approach. So all these need to be taken care of when you're looking at discount rate. Whenever discount rate is being computed or ascertained, the valuer must adjust the forecast, adjust the discount rate to account for those risks not already captured, and so on. I will just skip this. I don't think the cost approach part is very important. Let me skip this for now because we are short of time. So the valuation IVS 105 further says that the valuation model should refers collectively to the quantitative methods, systems, techniques, and qualitative judgments used to estimate and document value. So the idea is that whenever you're valuing a business, you have normally a model that you're looking at, and that model frequently looks like this, where you're looking at a NOPAT, and then you add depreciation, increase in working capital, increase in capex, come to the fund future cash flows for the firm, and then look at what the WACC is, then use that for computing a discount factor. Then discount factor is used to compute discounted cash flows, and then you kind of come at the enterprise value, maybe add cash, decrease the debt, come to the value per share for whatever equity shares you're valuing, maybe in this kind of a model that I've shown you here. Coming to IVS 200, IVS 200, so the definition of what constitutes a business may differ depending on the purpose of valuation. However, a business conducts a commercial, industrial, service, or investment activity. That is the main idea. Mr. Tarun, I will come to this topic of difference between equity value post-money and pre-money. Just let me cover up IVS 200 first because we are, of course, short of time here. So the idea is business conducts a commercial, industrial, service, or investment activity. Businesses can take many forms, such as corporations, partnerships, joint ventures, and sole proprietorships. The value of business may differ from the sum of values of individual assets or liabilities that make up the business. When a business value is greater than the sum of the recorded and unrecorded net tangibles and identifiable intangible assets of the business, the excess value is understood to be goodwill. So when valuing individual assets or liabilities owned by a business, value should follow the applicable standard. The idea is that whenever you are looking at individual assets or liabilities, then IVS 200 will not apply. It is better to apply 210, 400, etc., etc. That is the first part that we just read. Values must establish whether valuation is for the entire entity, shares or shareholding in the entity. So you must look at what you are trying to value, and the type of value being provided must be appropriate to the purpose of the valuation. The idea is that you might like to compute enterprise valuations. In that case, you often describe enterprise valuation as the total value of the equity in a business plus the value of its debt or debt related liabilities minus any cash or cash equivalents available to meet those liabilities. So the idea is that enterprise value will have a different meaning. And if somebody says that, okay, tell me what the business is worth, then that is what you will be computing, because that business is getting finance from debt, equity, maybe other things. But you are wanting essentially to compute the enterprise value. The other options are then to computing the total invested capital value. So in that case, you will be looking at, regardless of the source, often you will see that what is the value of total assets less current liabilities and cash. That is what then you will be looking at. So that's a different way of looking at the value of the business. Operating value is another way, where the total value of the operations of the business, excluding the value of any non-operating asset and liabilities. So you will exclude the non-operating assets and liabilities in case of operating value. Then in case of equity value, you will be then taking about value of business to all its equity shareholders. That is what you will be computing. So what value are you supposed to compute is very important. Any questions on this? Because this is a very important part that I just talked about, and I am speeding up because of limited time that is with me. All right, no questions, not a problem. Value of businesses are required for different purposes, including the possibility of acquisition, merger, sale of business, taxation, litigation, insolvency proceedings, financial reporting. These might be different reasons for doing the valuation of a business. When you talk about market approach to value a business, you normally talk about three methods. One method is public stock markets, in which ownership interest of similar businesses are traded. The acquisition market, in which entire business or controlling interest in businesses are bought and sold, and prior transactions in shares or offers for the ownership of the subject business. So you have three comparables. So what are the differences? The idea is, one is public stock market. So that is, you have the NSE, BSE, where you might have a share which is being traded. You might have an acquisition market. So one says that, okay, maybe, somebody invested these many dollars in Zomato, or these many dollars in Paytm, or this kind of investment happened in this company. So whenever that kind of news comes in, which is public news, where the percentage of shares that are required is known or easily understandable from any MCA search, that is the data that you use. Prior transactions shares or offers of the ownership of the subject business, you can always say that, okay, the business which I am trying to value had a value at maybe, at 100x, the value was there of its turnover about 2 months back. So it should not change dramatically unless and until something has changed in the business. So you check on that, and then you see what kind of growth was expected 2 months back, what is expected now, and then kind of use the same value at which the investment had come in into the company 2 months back, 3 months back, and then try and use the same method. There must be a reasonable basis for comparison with and reliance upon similar businesses in the market approach. So these similar businesses should be in the same industry as the same business, or industry that responds to the same economic variables. Factors that should be considered in assessing whether a reasonable basis for comparison exists include similarity to the subject business in terms of qualitative and quantitative business characteristics, amount and verifiability of the data of the similar business, and whether the price of similar business represents an arm's length and orderly transaction. So these are the factors that you will consider. Coming to income approach, that was more about market approach for businesses. income approach, there is normally enterprise value, equity value, that is the interest that is normally computed when you're doing a income approach for business or business interest. That is what you will be looking at. The income approach requires the estimation of capitalization rate when capitalizing income or cash flow, and a discount rate when discounting cash flow. So in estimating the appropriate rate, factors such as level of interest rate, rate of return expected by participants is required to be computed based on the inherent risk that is there. So you all understand the relationship between risk and return, right? So risk, higher the risk, higher the return. That is the normal concern. So if you find yourself valuing a business which is highly volatile, which is having a high risk, then you kind of say that, okay, I want higher cost of capital. I have a higher cost of capital. The moment you go to a business like FMCG, or maybe you look at a big corporation, you suddenly feel that no, my cost of capital is lesser, and I will not like to maybe expect that kind of earning from this stock. So you will try and give more value, or you will be ready to pay more for the same stock, which is going to give you maybe the lesser value, even if the risk is, because maybe because the risk is low. So in methods that employ discounting, expected growth may be explicitly considered in forecasted income or cash flow. In capitalization methods, expected growth is normally reflected in the capitalization rate. So this is basically how the discount rate can be talked about. I have a question, just give me a second. Okay. I think there's nothing. So under the income approach, the historical financial statements of a business entity are often used as a guide to estimate the future income or cash flows. Determining historical trends over time through ratio analysis may help provide the necessary information to assess the risk inherent in the business operations in the context of the industry and the prospects for future performance. So it is important for all of us to understand this. Adjustments may be appropriate to the difference between actual historical cash flows and what is supposed to be expected in the future. So examples would include adjusting revenues and expenses to level that are reasonably representative of the expected continuing operations. So somebody tells you, I have operations and I have these 4 lines of businesses. I will shut down one and I will continue the 3 others. So when you do the projections at that point in time, you can't just use the same numbers. You have to remove one division out of that number and then continue the 3 divisions, or put in maybe the numbers which are expected out of a new business that you start with. Presenting financial data of the subject business and comparison businesses on a consistent basis, then adjusting non-arm's length transactions. So you might have a transaction maybe with a related party entity, a subsidiary, a holding company, a group company. So you have to adjust that. Adjusting the cost of labor or items leased or otherwise contracted from related parties to reflect market price or rates. So you say that, okay, my prices are, I have contracted with my labor that they will work at 100 rupees per hour, but then that is not the market rate. So whenever you do a market approach and you want to understand that, okay, what is the expectation of the market with respect to that value, then you will work according to that. Reflecting the impact of non-recurring events from historic revenue and expense items. Examples of non-recurring events will include losses caused by strikes, new plant startup, and weather phenomena. Adjusting inventory accounting to compare with similar businesses. So you don't want to have too much inventory, or you want to adjust the inventory to make sure that it is at level with the market. The valuation of a business, when using an income approach, it may be necessary to make adjustments to the valuation to reflect matters that are not captured in either the cash flow forecast or the discount rate adopted. Examples may include adjustments for the marketability of the interest being valued, or whether the interest being valued is a controlling or non-controlling interest in the business. So when many businesses, while many businesses may have valued, may be valued using single cash flow scenario, valuers may want a multiple scenario. So in some cases, what we have done in our experience in the past is we have looked at multiple possible cash flows for the, just a second, just hold on, please. So the idea is that valuation of a going concern, when using an income approach, it also is necessary to make adjustments to valuation to reflect matters that are not captured in the cash flows. So you have to talk about maybe the interest being valued in a controlling or a non-controlling interest, and all those factors are also required to be discussed and talked about. When you look at cost approach, a business can be also valued using cost approach, especially where the business is an early stage startup or a startup business, or maybe an investment or holding business where you don't have any assets within the company, but you have more of a summation method that you use using the values or you want to give to the businesses that are owned by that business. Then the business does not represent a going concern, where the business is not a going concern. You want to say that the business is almost over, it is at the end of its life cycle, and you don't want to value it as a business. Special considerations for a going concern will include ownership rights. You should look at what are the ownership rights, minority rights, controlling interest, what kind of whether is it a minority shareholding that you're valuing, what kind of interest do they have. In case of a convertible preference share or a convertible capital, then that is what you look at. Business information, economic and industry considerations, operating and non-operating assets, capital structure considerations, all these need to be looked at special considerations. Let's talk about these. So ownership rights talk about rights, privileges, or conditions that attach to the ownership interest, whether held in proprietorship, corporate or partnership forms, and so on. So they require consideration and valuation process. Corporate documents may contain restrictions on the transfer of the interest, other provisions related relevant to value. For example, corporate documents may stimulate that the interest should be valued as a pro rata fraction of the entire issued share capital, regardless of whether it is a controlling or non-controlling interest. Ownership rights, then we continue to say that care should be taken to distinguish between rights and obligations inherent to the interest and those that may be applicable only to a particular shareholder. Depending on the basis of value used, the valuer may be required to consider only the rights and obligations inherent to the subject interest, or both those rights and consideration inherent to the subject interest. So ownership rights can then be, when you talk about ownership rights, you're talking about all the rights and preferences associated with a subject business or business interest should be considered in evaluation, including if there are multiple classes of stock, the evaluation should consider the right of each different class, including but not limited to liquidation preferences, voting rights, redemption, conversion and participation provisions, put or call rights. All these are important. So when a controlling interest in a business may have a higher value than a non-controlling interest, control premiums or discounts or lack of control may be appropriate depending on that. Business information. So it is important for the valuer to assess the reasonableness of the information received from management, representatives of management, other experts, and evaluate whether it is appropriate to rely on that information for the evaluation purpose. So although the value on a given date reflects the anticipated benefits of future ownership, the history of business is useful in that it may give guidance as to the expectations for the future. Economic and industry considerations. So you must look at what are the important factors, what is your registered location, what is the nature of business operations and location of each division function, whether the business sells its goods or services, where the business sells its goods or services, where the suppliers of the business are located, tax and legal jurisdictions. All these are industry and economic considerations that you must look at. In case you're valuing a power plant and you don't understand the situation of thermal based power plant in India, you don't use income environmental concerns in your valuation approach, then maybe you're missing out something and you might end up doing a valuation which is far from reality. Operating and non-operating assets, it is a must for any business valuer to look at the items which are forming part of a business, but which are non-operating in nature. There might be some machinery which is not underused. There might be some land and building, which is a guest house, which is not being used, which is redundant or excess. There might be excess land which is available with the company, and that piece of land is not being used for the business, but that is a cost or that is a value which is supposed to be added to the business value as a non-operating asset to compute the value of the holdings of the equity shareholders or the business value as a whole. So when you look at what is the money that has been invested into the business, then you will get a situation where all that will also become part of that. I think I've already talked about business capital structure considerations. So you have to look at what kind of interest can there be. It can be bonds, it can be convertible debt, it can be partnership interest, it can be minority interest, common equity, preferred equity, options, warrants. All that can be capital structures that are important. A non-exhaustive list of such rights and preferences may include dividend or preferred dividend right, liquidation preferences, voting rights, redemption rights. So make sure that these capital structure considerations are looked into by you. And then you can use all these methods to identify that. So I think I will use I will use less time, and then I will complete this process, and we will. I think maybe maybe you can take over, and maybe we can close this session. So then we have another session starting at 5. So I think everyone is requested to use that link. So I think Mehak, you can take over, or maybe whoever is available.
Yes, sir. First of all, we are very sorry that we are short of time, and we are sorry that we'll have to stop you here. And thank you for coming. Thank you for this session. So now, for those who are who have paid for the next session, they can join in the next link. You might have received the link. If you haven't, you can please message me already so that we can do the needful as soon as possible. So thank you, everyone. Thank you for today's session.